one of the anecdotes we hear a lot from our more climate aware clients is that there's no point holding a clean portfolio on a dirty planet. So practically speaking, like, what can you do to show real world emissions reduction? Well, a couple of examples there would be you can invest in companies with credible decarbonisation plans, right? You can find companies with ambitious targets, and not just ambitious targets, but showing that they're actually hitting those targets and they're actually taking the action they need to get to the ambitious targets they've set.
Hello, ladies and gentlemen, and welcome to our interview with Matt McGlinchey. Matt is a senior climate product manager at Morningstar Sustainalytics, and welcome to our Risk Management Show podcast. Matt, it's my pleasure to welcome you.
Thanks so much, Boris. Yeah, great to be with you, and thanks a lot for the invitation. Looking forward to speaking with you today.
Yeah, so our topic will be so we will have a thoughtful conversation on the topic of how financial institutions are integrating climate risk into their core risk management processes. We'll explore also why it is important to assess and mitigate low carbon transition in physical climate risk, and the role research data analytics plays in this ecosystem that you are very skillful in this area. But before that, could you tell us a short story about yourself, what your career path, and what brought you where you are right now, and what you guys at Morningstar Sustainalytics up to these days? I know the very famous company. I'm reading some reports of investment funds, but Sustainalytics is kind of new for me.
Yeah, sure. No, sure. Happy to provide a bit of context there. Thanks, Boris. So yeah, I'm a product manager for climate solutions at Morningstar Sustainalytics. So at Sustainalytics, we're really one of the leading ESG data research and ratings firms in the market, right? So we're supporting mainly financial institutions with their development of responsible investment strategies. So that's kind of the broad role that Sustainalytics plays. And then our climate solution specifically, so the team that I work in, they really run the full gamut from carbon emissions data through to low carbon transition research, physical climate risk data, climate impact, and other topics as well. My background really financial services for the last 15 years. So in my old job, I worked across the Nordics. In that region at the time, companies there were probably more ahead than a lot of places when it came to climate and embedding some of the climate factors that we'll talk about today. So it's been an interest for a long time, and it's been really exciting to be able to be sort of fully immersed in the world of climate at Morningstar. And yeah, as I'm sure we'll discuss today, climate risk is not a topic that's going to disappear anytime soon. So hopefully it's a good time to be connecting.
Yeah, absolutely. It's perfect. It's on top of everyone's agenda and in use all the time. We have now a lot of storms. We have a lot of damages from fire. So everything is affected in the world. But let's do a deep dive into integrating climate risk into risk management. What financial institutions are increasingly integrating climate risk into their core risk management processes. And what are the main drivers behind this movement, and how have these drivers evolved over the last decade?
Yeah, I think it's a good place to start, Boris. So yeah, thanks for that question. I think yeah, maybe start with some of the main drivers of movement in this space, right? I think maybe to start with, and hopefully it's not too flippant to say the main driver of movement for financial institutions is climate change itself and some of the visceral impacts that we're seeing in the more extreme weather events around the world that you've just mentioned, right? So this week alone, what we're seeing in Los Angeles with those devastating wildfires caused by those unexpectedly strong Santa Ana winds coming off the desert, the floods at the end of last year across southern Spain, particularly Valencia, the typhoons across the Philippines last year. There's obviously too many examples to mention here, unfortunately, but of course, this really does expedite, it intensifies the conversation around climate risk for financial institutions. And by that, I really mean both traditionally the risk mitigation, but also increasingly the kind of adaptation efforts that are going to be required, right? So in terms of combating those effects on the ground that people are seeing every day when they turn on the news. So that's kind of, I guess, the umbrella driver of everything really. I think within that, another big driver that's really pushing more activity in this space is the increased amount of data that's coming along with those developments, right? So You may have seen just this morning in Europe a headline piece of climate data released by a body called the Copernicus Earth Observation Programme from the EU. So the headline there was that 2024, the first year where global temperatures were more than 1.5 degrees above the pre-industrial level. Now that's the key threshold of the Paris Agreement, which was set at COP 10 years ago. Now, news like that really embeds that awareness that without drastic action to turn the tide, we're on our way to likely quite catastrophic heating scenarios by the end of this century, right? So, at my firm, when it comes to our own climate transition research, we're trying to look at companies' exposures to transition risk, as well as crucially an assessment of the company's action that it's then taking, both in terms of target setting, progress towards those targets via its management. So maybe a bit later on, I can go into a bit more depth on some of those factors that are being used by our clients. But the headline output of that research that we have at the moment as well is that um, across our universe, on average, companies are usually contributing to a temperature rise of between 2 and 3 degrees by 2050 via their own activity as well. So very few are close to aligning with the net zero pathway. So this kind of data that's coming out is a big driver of movement. Thirdly, climate regulation. I think amongst the context we've just spoken about, it's driving more regulation with more frequency that's hitting both corporates and then also financial institutions themselves with more intensity. So maybe it's helpful just to give a bit of a regional flavor there. So in the US last year, we saw the SEC decision that companies now need to report on scope 1 and 2 emissions. They left out scope 3 for now. Another acronym, sorry to throw another one at you, but CSRD in the EU. So that's driving a lot more disclosure on climate risk at the corporate level. It's not just a purely climate focused regulation, but financial institutions are really hungry for that data, right, to feed their risk modeling. And if we take a global view, we're seeing TCFD. I'm sure many listeners will have heard of that. The Task Force for Climate Related Financial Disclosure. That's being embedded, continues to be embedded either on a voluntary or mandatory basis around the world. And maybe just to pick out one useful example of where there are regional additions there. Australia and New Zealand right now, a big focus there in the regulations there on quantifying the potential financial loss from physical climate risks. So like a broad baseline globally, and then in each region, a bit more focus in
Mhm.
certain areas. And then
Mhm.
maybe just to finish on a positive note in terms of some of the drivers here, there are a lot of positive case studies that can be leveraged by our clients right here, and crucially, a lot of networks being coming into fruition that are helping drive kind of collaboration. So that could be at the private and the public level. If we take an example of a company like Ørsted, a Danish company, used to be one of the most coal intensive companies in Europe. It's embarked on a pretty stunning green transformation. It's now one of the world's most sustainable energy companies, right? And there's plenty of other examples like that to leverage. Sovereign level, Sweden on track to reach 100% renewable energy by 2040. Kenya leading the way in Africa, a single wind project there supplying 1 million homes. I think for our clients, for financial institutions, there's plenty of networks as well springing up to help share these types of resources. If you look at the Glasgow COP, GFAN's initiative there coming out, there's a lot of really good collaboration and learning coming out of that. So these kind of positive examples can be really powerful, right? So increasing collaboration, increasing the quality of climate strategies, and the building out of the scale needed. So there's a huge amount of activity in this space, but I think, those are some of the key drivers of activity we see across the world.
Great. So let's discuss how low carbon transition and physical climate risks combine each other. So why is crucial for financial institution to assess and mitigate low carbon transition risk and physical climate risk? Can you perhaps share some examples or strategies or tools that are particularly effective in addressing these challenges?
Yeah, I think there's a couple of really interesting examples to highlight within both of those spaces, right? And I think it may be important to mention at the start here as well. Like we look maybe 10 years ago, many firms either weren't looking at these types of processes you mentioned there, or those kind of risk strategies, or it was a really small siloed part of the operation, right? And what we're now seeing is heads of climate risk at our firms becoming a lot more powerful with a lot more decision making. And we're getting a lot more interest in the type of data and research that will help our client firms to embed these kind of strategies across their organizations. Maybe in the transition space, a good one to start with. It's a broad trend we're seeing across a huge swathe of institutions is kind of excluding high emitting sectors from a lending book or from a fund isn't enough anymore to be an effective risk management strategy, right? So instead of then just washing your hands of sectors like agriculture, manufacturing, transport, and just looking to decarbonize your portfolio, which may have been sort of a core strategy in years past, what we're really seeing now is our clients really wanting to take a much more sector agnostic view, trying to isolate the climate leaders of tomorrow who can really achieve real world emissions reduction. One of the anecdotes we hear a lot from our more climate aware clients is that there's no point holding a clean portfolio on a dirty planet. So practically speaking, like what can you do to show real world emissions reduction? Well, a couple of examples there would be you can invest in companies with credible decarbonization plans, right? You can find companies with ambitious targets and not just ambitious targets, but showing that they're actually hitting those targets and they're actually taking the action they need to get to the ambitious targets they've set. And that's particularly prevalent right now on those interim targets. You hear a lot about that move to 2050, but actually it's really important to find those companies that are setting and hitting interim targets to 2030, right, in that initial path to net zero. So there's always going to be companies to avoid, but in the transition space, there's a lot of companies that need just good investment and good engagement on where they need to improve. And I think, some of the factors there that you might then be looking at as one of our clients to help, embed some of those strategies would be something like an implied temperature rise, right? So
Mhm.
what is this company's activity and its exposure to risk saying about the warming scenario that would happen if all other companies behaved in that way? So that's a real sort of core metric that we see a lot of our clients wanting to use. Value at risk, right? The potential financial downside based on a series of different climate risks, including transition risk. And then crucially, things like an assessment of company action, company engagement as well. So financial firms are really trying to collect their own data right now as well, right? On the outcomes of those engagements they're having with companies, on the climate targets that they have. So they want to show those resources they're putting in are having a positive change. So you need to make that measurable, right? You need to have set climate KPIs that is pretty crucial there, measurable, data driven, and we try and support our clients with that part of their risk mitigation pretty directly. Maybe finally, there you mentioned physical risk as well, Boris. So on the physical risk side, some really interesting work being done right now across the world. I'd say, our team at Morningstar doing some interesting work, trying to help our clients attach kind of specific weather-related financial risk scenarios to their analysis. So again, to use another example from back end of last year, Hurricane Helene had such a devastating impact on parts of the US, including North Carolina.
Mhm.
Um, so if we look back at that, right? So potentially their flood risk maps can be very helpful to pinpoint low-lying regions most susceptible to flash flooding, right? And to take a town as an example there, if we take Asheville, North Carolina, which unfortunately bore a lot of the brunt of that flooding, there is a big correlation there between the lowest lying regions and the major residential and commercial arteries. So that kind of linking of data, finding those kind of data webs that can help you understand those kind of insights from kind of high resolution flood modeling in this case, that can really help enhance kind of mortgage underwriting, corporate lending, making sure risky loans aren't going to high risk locations. From a financial perspective, this helps avoid some of the worst financial impacts, right? And those resources can then be spent elsewhere, maybe on adaptation measures or other processes as well. So yeah, I think across the transition, the physical risk space, there's a lot that our clients are doing. And maybe the other we can talk about this maybe in a little bit more detail, but the final piece would be actual emissions data itself, particularly scope 3. So I'm happy to go into that in a bit more detail as well.
Yeah, yeah. I heard that also this area of high damaged area in Los Angeles now. It turns out that it was almost a lot of percentage of houses were not insured because the insurance cost is so high that, that people
Yeah,
are
it's
not.
it's 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 a great point, and we see that a lot. I mean, I was at Climate Week in London last year and talking to talking to some people that work for insurance firms kind of globally, right? And even there's obviously regional sensitivities when it comes to climate, right, from the political standpoint, but you tend to find, yeah, that the insurance market is quite a good place to track to see what's actually happening in the ground in some of those places, right? And if you look at how many insurance firms have pulled out of places like Florida as well, due to some of the really high impacts we're seeing on the ground there, that yeah, it's very unfortunate for those regions that are experiencing those real acute effects.
What are the future of climate risk management? Looking ahead, how do you see the role of climate awareness among the retail investors and institutional asset owners evolving? What opportunities and challenges do you anticipate in driving real-world emissions reductions and promoting climate transition funds?
Yeah, I think the retail part of that question is definitely super interesting right now, right? I guess we would probably, again, and as you would probably expect in a lot of parts of of finance, it tends to be the institutional space that drives the evolution, right? And in the retail space, probably comes a little bit behind in terms of awareness. With climate, it's maybe slightly different, right? Like as we said at the top, like climate change is on our screens every day. It's around us, not even on our screens, it's around us physically, right? It's something that everyone is becoming more and more aware of over time. And I think what we've seen really, it's clear now that anyone on the street that wants to invest their money, whether that's through a brokerage, whether it's through their pension plans, right? On average, it's of course a generalization, but they're going to be more aware of the effects of climate change right now than they were a decade ago, for instance, right? So this has been coupled, this kind of general trend of more climate preferences being passed down the investment chain, I guess you could say. It's also been, I mentioned regulation before. There's also been regulation that has helped to crystallize that as well, right? So MiFID 2, to throw another regulation at you, that came in quite a long time ago now in Europe, that forced financial firms to take into account their end client preferences, right? When it came to sustainability, including climate. And that includes firms that face the retail market. So there's actually a mechanism now, right, to make sure that those investor preferences are taken into account, including, risk tolerances on climate. And so it's kind of forced that exchange of information, um, both more organic and also more standardized as well. But I'd say as well, like, due to the political environment as well, and we may talk about that a little bit as well in a bit more depth. But climate change doesn't really democratize; it doesn't affect everywhere equally, and so those concerns, those preferences, they're not maybe as pronounced to the same degree everywhere. I was talking to some advisory firms in Canada recently that they're seeing an uptick in how many times their retail clients are mentioning climate when they ask about potential investment opportunities. We don't hear that everywhere, right? And that will also be a more simplified dialogue, right? You asked about institutional as well. Maybe just to give a kind of an example of the more complex dialogue there might be in that space. There's a ton of asset owners right now that are trying to find the right asset manager, right, to implement their more evolved climate strategy. So we hear from asset managers right now whose asset owners are asking them to show how their funds are performing against external frameworks. So to give an example, the IGCC has a kind of net zero investment framework. It's called NZIF. And it's really helpful for trying to quantify how a fund is investing in a way that aligns with net zero. So that kind of ask from an asset owner, that drives a lot of activity, right? You then need to make sure that you're aware of what that framework is, you have data that can support it, that if you have climate strategies that in some way they might be focused on improving the investment universe against the criteria that somewhere like IGCC is setting. So it's kind of the same conversation in a way. It just gets obviously a lot more complex when we're talking about an institutional investor. But yeah, I think in both of those parts of the market, we're only going to see the awareness and also, I guess, the complexity or how advanced those asks are is only going to increase over time, just from a lower base in the retail market.
Mhm. Okay, Matt, I would like to ask you a personal point of view. What are the major misconception in your field of climate risk that you kind of strongly disagree with?
Yeah, it's a really good one actually. I'd say like we kind of hear a lot. One thing would be that climate risk is only really performed by climate focused professionals, right? And therefore, climate analysis is only useful on, say, climate labeled funds, right? And anyone that is aware of kind of the broader ESG world the last couple of years would have seen some relatively major outflows from ESG focused and also some types of climate focused funds the last couple of years, right? And we do a lot of research on that within Morningstar. We have a lot of kind of good reports that our research team build on that kind of global fund flows. But that doesn't really tell the whole picture, right? As we've already discussed, like, yes, there are climate focused strategies, but actually in the climate space specifically, it's been embedded across embedded across organizations in the finance space, right? So actually what we see a lot of the appetite right now for climate risk is actually on those strategies that aren't even labeled as climate, right? So I think we can often maybe underestimate how much movement there is in this space right now if we only focus on that part of the market that, where the fund has the word climate in its title, right? And I think as well, maybe to follow on from that, another example I would give of maybe a misconception is that I think one of the reasons, one of the main ways that ESG kind of investing or sustainable investing enters the market right now is around that idea that, there's an inherent friction between return and investing in ESG, right? Which has maybe driven some of those outflows that we talked about. Of course, again, in the climate space, and particularly where we're talking about transition, I think we're seeing more and more now. We get it fed back by our clients that they don't see that friction as much in the climate space, right? If you're trying to find those climate leaders of tomorrow, particularly in the transition space, right, then you're likely investing in those firms that are future-proofing themselves for a longer time period, right? That are setting themselves up to exist more happily in a low carbon economy. So I think particularly when building out transition strategies, that's we still see a lot of movement and a lot of interest in that space because there's a shared understanding in the market that return or alpha, as a lot of people would call it, doesn't have to suffer because you have a focus on an area like climate. And I think that's maybe a way that can really help drive some of those incentives to change the relatively bleak picture we talked about at the start, right? So those would be two common misconceptions I think we hear of. But of course, we hear requests of all different stripes coming in from our clients. I cover our global client base, so it's always very interesting to see how those play out regionally as well.
Fantastic. So if we summarize our interview for someone who is listening and would like to walk away with one or two major takeaways, what would that be?
Yeah, I think well, the main takeaway would be that this is not going anywhere, right? When I talk to my friends based in different parts of the world, like it's interesting, even outside of work, they know I work in the climate space now, but I tend to get a lot more questions than I used to about what's going on. And I think I would say like the mainstreaming of some of the things I've talked about today is definitely only going to continue, right? And I think of course, everyone is concerned about the way things are going, but I think that off the flip side, I would like maybe a takeaway to be that there is a lot of great work being done at the moment. We didn't really get a chance to talk as much about COP in Baku last year, but there was a bit of a disappointment, right? That the financing that was required, which was around 1.5 trillion a year for developing countries, didn't quite get met, and we ended up at a place of about 300 billion initially a year. There's a lot of kind of uh, maybe slightly more negative news stories coming out about that, but there's still a lot of hope, right? If we then take the flip side, there's a lot of hope for COP next year in Brazil, with the big focus there will be on nationally determined contributions, essentially each country's progress towards the Paris target. And there's a lot of good movement there to suggest that by the time we get to that next year, there will be a lot of positive movement in that space in terms of some of those determined contributions, for instance. And then we've already talked a little bit about, some of these flagship companies and how they're really leading the way, and the fact there's a practical and repeatable path to get to alignment with net zero as well. So as ever with this space, it's a mixture of some quite worrying news a lot of the time, but a lot of hope still that the situation can be turned around. And I think anyone that's interested in getting more into the climate space, it's so incredibly dynamic, and there's you can really make a difference to what's happening on the ground. So I think I would of course I'm biased, but I would definitely advocate more awareness, more education in this space, and always great to connect on this topic because it's affects so many people's lives every day, right?
Absolutely. I also would like to stress that our site, globalriskcommunity.com, we don't have much discussion about climate risk. I think we kind of people normally people leave it for professionals in high high cabinets about this. Maybe your company can participate in some discussion on our forum. It will be great.
Yeah,
Well,
we'd love to, and yeah, and of course it'd be great. I think it's such an ever-changing space. I think it's be great to catch up again sometime on maybe any progress that's been made from the situation where we are today. But like I said, yeah, I think climate risk is definitely becoming more mainstream over time in some of our larger clients' organizations, and I think that trend will continue. So I'm sure you'll see the topic pop up a lot more, even when talking to maybe risk managers that haven't traditionally focused on climate as much in the past.
exactly. Fantastic, Matt. That were all my questions. If I forgot to ask you something that you feel is important to our audience, please go ahead.
No, I think that was everything. I mean, I think we had maybe planned to talk a little bit about the kind of political environment and some of the aspects that we're seeing there. But I think we covered that, we covered that in terms of the last question, in terms of talking about the various COPs, right? I would say that again, like you mentioned Los Angeles again earlier, like we are seeing some criticism of some of the political figures involved there in terms of the amount of adaptation and mitigation funding that was in place there, right? So again, I would just use that as that kind of confluence between the political situation in places and then the financing aspect that's required and making sure that that is kind of that is kind of aligned is obviously going to be crucial as well as we go forward. But every time we see something like this happen this week, which is so devastating for the people involved and obviously makes a lot of places wake up to the risk here, I think it's only going to drive more positive change as well.
Right, fantastic, Matt. That's a very interesting episode and specifically something that stayed apart of our usual discussions. So I wish you a great success and you and your company, Morningstar Sustainalytics, perhaps we can discuss more cooperation in the future. Just you guys sharing a lot of your information that you have on our site at globalistcommunity.com. But it will be great if you can propagate your knowledge to average masses in the field.
Yeah, for sure. No, we really appreciate the chance to talk to you today, Boris. It's been really good fun and really insightful to hear from you. So thanks a lot. Yeah, and hopefully we'll connect again in the future.
All right, thanks. Bye bye.